The first big risk you ever took in your career, and how did it play out?
When I transitioned away from safe, steady consulting-based role, I was at Accenture for close enough to 3.5, 4 years. I felt that probably wasn't for me after a certain number of years.
What are some of the objections these institutions have before committing to something like this?
In the traditional world, there is typically somebody to pick up the phone to, there's somebody to complain to. In crypto and the blockchain space, once a transaction goes through, it's final, it's irreversible.
What does a disaster look like in your world?
FTX being the most kind of pertinent example with Sam Bankman-Fried and FTX, that was really just fraud. A centralized crypto exchange should always be one-to-one backed with the assets that a client has deposited.
Where yield comes from when it's on the blockchain.
There's 2 or 3 ways in which you can sustainably generate yield. One typical yield source on-chain or in the crypto space is staking.
When do you see this becoming mainstream?
I'd see blockchain technology and crypto as just an enabling technology in general to do things that we've pretty historically done, or maybe not been able to do, but just in a more efficient manner.
Hello, I'm Kieran O'Connor and welcome back to the Calculated Risks podcast. Today is episode 17 and I am joined by Matt Molloy. Matt is the CEO and co-founder of TruYields. TruYields build institutional grade digital asset infrastructure that bridges traditional finance and DeFi. Founded in 2023, they currently have $300 million assets under management, and they're trusted by hedge funds and family offices around the world where they can deploy their capital into crypto native investments. Matt, thank you very much for coming on the podcast.
Thanks, Kieran.
I'm very excited for this one because I've interviewed a few people in the Web3 blockchain space.
Yep.
It's very prominent right now. And I'm excited to come on to that part of the conversation, but we do start the same way every time. And I'd love to understand the first big risk you ever took in your career and how did it play out?
Okay. Yeah, I guess the first big risk from a career perspective for me was probably when I transitioned away from kind of safe, steady consulting-based role. I was at Accenture for close enough to 3.5, 4 years. And the trajectory there it's pretty predictable. You spend a certain amount of time at each level. You go from analyst, consultant, manager, and all the other levels, and you kind of see your career quite evenly mapped out, and a lot of people around you have done the same journey. It's kind of predictable, as I mentioned. I felt that probably wasn't for me after a certain number of years. You can learn an awful lot in those environments, especially with a lot of different clients, great people to work with. But for me, that kind of wasn't super appealing to having something very predictable. So I moved and I guess jumped ship away from the consulting world into something much, much smaller, much kind of more fast growing at that point in time in terms of a fintech focused private equity firm. But that was really the catalyst for me to, do a whole lot of other things as well. And from a career perspective, it was definitely quite a transitional point or a pivotal point, I'd say, in my career. And it was a pretty sizable risk at the time. In and around that time, there was kind of COVID happening. It was certainly anything but a stable environment. But for me, it felt like the right thing to be doing long term, even if, the short term volatility and things like that were something to be contending with. So that was probably the biggest career risk for me, was moving away from a consulting organization with 500,000 people into a small boutique private equity firm, which motive partners with less than a couple of hundred people at that point in time. So it definitely felt like a big risk at the time.
Yeah, I want to stick on that for a minute because I've had many people on the podcast who have done a similar journey, big consultancy, big company. Then they transitioned even to a smaller company. It might be as small as a startup. It could be a couple of hundred employees. I know for all the people I've spoken to that the big consultancies do a lot of things very, very well.
Yep.
But it's a bit of an eye opener. You'll probably tell me when you join a company, one whatever of the size, what sort of things shocked you the most?
I think at the outset, the first thing that kind of surprised you, probably shouldn't surprise you, is just how much more you have to be doing yourself and the self-reliance. And for me, I've always enjoyed that side and been somebody who's quite happy to kind of work with whatever resources I have at that point in time. But within Accenture, you have layers upon layers of support staff and specialists in certain areas, and you could always turn to somebody in the organization who'd probably done exactly the problem which you're working on, but maybe with a client a couple of years ago or even more recently. So you always had a reference point and almost a guide for how you would deal with a particular challenge and problem. And I think going into a small organization, whether it's a startup or even just small organizations in general, and starting company as well, a lot of the problems you're dealing with often are it's the first time you've dealt with that problem, and also probably the first time anyone in the company may have dealt with that particular challenge. And so I think there's just a lot more need to kind of think through from kind of first principles and from the ground up how you're going to approach that particular challenge. and working with what you've got and being able to kind of take a calculated, like you'd say, kind of risk or decision based on a hypothesis, and then being very quickly able to change or adjust depending on the feedback and whether it's working or not working, and pivot accordingly. So I think that's probably the biggest thing, which, not from a shock perspective, but is a huge difference between a large organization, consulting business, to going into something much, much smaller.
Wearing all the hats is a classic term.
Yeah, exactly. You are expected to do a bit more in all the different areas, which, if you're more of a generalist, it's a great thing to be in, or a great kind of position to be in, and to learn very, very quickly. But it can feel probably quite daunting at times. And you always feel as if you're kind of treading underwater, trying to keep your head afloat. But that's probably where the fun is.
Yeah. So that was around COVID time. You said that was the first big risk you took. You left consultant,
Yep.
Structured career path. What about now? A few years later, 2, 3, what's your relationship like with risk taking?
Yeah, I'd say I'm pretty comfortable with risk taking in general, both kind of work and life perspective. I suppose work wise, I moved from something financial services to fintech, and then into crypto, which kind of almost goes out on the risk curve as you kind of go across those different product sets and different verticals. So I think from a risk perspective, I've always been willing to move to the areas where I think there's the highest opportunity, highest level for growth, whether personal or company as well. So I have a strong appetite towards risk. And then similarly, I moved away from London in terms of being there for 10, 12 years, working at least for 10, and move out to Dubai about 9 months ago. And for me, that was at that point in time, life-wise, a lot going on, business. We were just closing a funding round. So there's a lot on the table at that point in time, which could have been and was probably quite stressful, but it still felt like the right thing to be doing, the right move. And you just got to see what the potential payoffs are from each side and weigh up whether you think it's going to be net positive or not, and whether you can walk back through that door as well. I think a lot of decisions are you make them and then sometimes you can't go back, but the vast majority are pretty much decisions you can make, and you can always go back and adjust and change. And as long as those are the doors you can walk back through, I think it's absolutely fine.
If anyone looks at your CV, LinkedIn profile, the journey that you've been on kind of looks like it's been a strategic direction. You've left consulting, financial services, now into crypto, but I'm sure it wasn't as straight as that.
Yeah.
But when did crypto, Web3, blockchain come onto your radar?
Sure. It would have been when I was actually working at Accenture around 2018, 2019, probably 2018 at that point in time. I was working day to day in kind of fintech and financial technology related startups, and running the fintech innovation lab later on at Accenture. So I was always towards financial services use cases and kind of technology as a whole. But really kind of crypto was more of a kind of passion project for me, something that I found intellectually interesting quite early on, or not super early compared to others, but 2017 was probably when I first heard about kind of crypto, and you saw the volatility in kind of Bitcoin and other things at that point in time, which were still ongoing. And that was really just from a personal perspective, I was interested then. And then when I started to work at Motive Partners, there was just the opportunity to move away from just doing fintech related work. And there was getting more and more interest, especially from some of the portfolio companies and also some of the entities we engage with around what was blockchain technology, what's digital assets, what's crypto, helping them understand that and start to build businesses around it. And that's really the point at which I was able to, I suppose, turn that kind of passion project area of personal interest into something which was kind of more directly involved in the day-to-day work that I was doing.
And did you start the business, which is TruYields, rebrand, we'll come on to that,
Sure.
2023?
Yes. So we started the business in 2023. It's a slightly kind of weird journey to becoming a founder as well, I guess. I was at Motive Partners, and at Motive Partners, I was in charge of kind of running their digital assets department, or kind of area of the business. That involved working with portfolio companies that invested in to understand what could be the digital asset strategy for them, how could they leverage blockchain technology, as well as that side of it. We were also trying to work with the latest technologies that were coming out of the blockchain and crypto space, and so we started and incubated a couple of businesses, and things were looking pretty positive there. But in and around that time, FTX happened, which was pretty much a death knell to the businesses we were building at that point in time, at least because they were so early stage. And then all of the traditional businesses we were engaging with kind of pulled back. We had a few Latin American banks and clients. And so it was pretty challenging. But from there, I kind of went and was fortunate enough to go over towards Brevan Digital, or kind of WebN Group, which is the Web3 incubator for Brevan Digital. And that's really where what's TruYields now, but was previously called TruFin, was incubated out of. So it was a kind of an incubation project as opposed to something which was started outside of the hedge fund.
Mm. So by the sounds of it, you had gradually more and more exposure to this world,
Yep.
year after year. I think even the average person who isn't interested in crypto and blockchain would have said post-COVID was a very bad time for the crypto market, just in terms of perspective, safety, I guess. What did people around you say when you decided to go out on your own 2023 and move completely into this space?
Yeah, I think there's, for those that are closest to me, so I don't know, family, friends, I don't think it came as too much of a surprise, because that's where I really wanted to be. But I definitely think there was an element of, from the outside in, it probably looked very risky to be going into something which looks, super volatile, very insecure in comparison to more steady jobs. But I think the world was kind of in a bit of a state of flux anyway. I didn't know where you were really looking. It was very difficult if you work in a software business, if you were in kind of almost any kind of technology focused industry. It was a very uncertain time. And this was before kind of AI really kicked off and generated a lot of attention as well. It was just quite uncertain as to how any industry was going to play out. But it did feel with one that had huge potential in terms of the growth of that industry in comparison to some of the more traditional asset classes and areas where they've been around for 50, 100, couple of 100 years. Some of these businesses going to something which is still relatively nascent, early stage, but where you felt that I could apply all the things I'd learned previously over Accenture and private equity and fintech, but with a lens to then support institutions in the crypto space. It felt like a kind of a risk in a business worth building.
And let's start with the business now, because we'll come to the rebrand, but tell us what the business does today. How do you explain it to the average person, but also then to institutions as well who are looking to invest?
For sure. So the business is called TruYields, and so we build institutional grade yield products for clients that are wanting to generate yield on their crypto or on-chain holdings. So this could be anything from a crypto native asset like Solana, Ethereum, all the way through to more stablecoin and US dollar based assets as well. So we try to provide a safe and secure mechanism and kind of infrastructure for typically institutional clients. So these could be family offices, hedge funds, asset managers, to essentially access yield on chain in a way in which is safe and secure for them.
So I looked online and it says your mission is to make the platform secure, compliant, and scalable. Also, some of the notes you shared, which are very helpful.
Yep.
You did 5 security audits, which sounds like a lot to me.
Sure.
Like, is that normal?
I wouldn't say it's normal or typical for the industry that we operate in. So we kind of blend the world between traditional finance and DeFi, so decentralized finance. A lot of the businesses or protocols that operate in that space don't necessarily go through that level of rigor before launching a product. But for us, because of the types of clients we are wanting to serve and the expectations they have around risk, security, compliance, it's something which we felt was the right thing to do. And for each new product that we launch, we're going to take at least one additional security audit for those. We're working at the moment on both SOC 2 and ISO certification as well. And so there's a lot of things that we as a business, based on the clients we serve, have to have in place, which is probably non-typical for the types of businesses that operate in the space that we do.
How much is it? How much is the investment into these security audits? Are these quite pricey?
Yeah, they're quite pricey. Yeah, you're talking like tens of thousands of dollars, depending on the type of provider. You can definitely, and people do go cheaper as well. You'll then see a lot of the businesses that maybe have gone with a cheaper provider a few months later will be the ones in the news with a kind of a hack or a vulnerability, which is never what you want to see. We also have a few things on an ongoing basis. So an audit will be at a point in time looking at the vulnerabilities of the smart contracts, which is kind of the code that runs the business and the protocol. We do those smart contract audits at a point in time just before release to make sure that we're confident there's no bugs, vulnerabilities, or anything we should be concerned about. But then we also have continuous and ongoing and kind of proactive monitoring of all of our contracts, all the wallets that kind of integrate and interact with those smart contracts, flagging for anything from anti-money laundering concerns and other aspects as well from a security perspective. And then we also run proactive bug bounty campaigns as well. So if you imagine there are hackers, both good and bad. There are people out there who, as a kind of career and as a job, will go out, find vulnerabilities, and you'll essentially pay them for finding those. We've been fortunate to have none of those so far. So it's one of those where we're thankful on both sides. But there's a lot of things that we would have to do and want to do to make sure the way in which the business is constructed is safe and secure.
Now, I've got loads of questions. Some of these are relatively basic for people that aren't as involved as the industry. Some might be a bit more complex, at least to me. But I want to jump on the rebrand because if I'm not mistaken, 2 years into the business, you've gone for a rebrand, 2.5.
Yeah.
Seems soon, but I'm sure there's a strategic reason. So TruFin Labs,
Yes.
before, and now TruYields. Talk to me about the story behind this.
Yeah, absolutely. So TruFin was the initial name we came up for the business, and it was at that point in time when we did conceptualize the business, we weren't 100% sure on what products we were going to be launching, which particular vertical of crypto or DeFi we'd be serving. And therefore, we took something which is pretty broad, like TruFin, True Finance. At the time, we thought it was a good name. It's something, though, it doesn't really convey anything, and you very much need to be describing exactly what you do for people to recognize it, and it just doesn't have much brand recognition at all. So at that point in time, after a couple of years, we were building out one particular kind of product vertical, which was the liquid staking space, and can come on to that later, which is essentially just yield for the provision of staking services for proof of stake blockchains. We had that particular product set, but we knew we wanted to build kind of more broad other types of yield products. And we therefore knew that we were basically building out a suite of institutional grade yield products. And therefore, would there be something along the lines of yield or a naming which includes yield that would help us to convey that message more clearly? We therefore kind of just looked around, as people do at the moment, obviously put it into a few different LLMs, came up with a few suggestions, didn't really like most of them, and then just went for something which was more, I guess, we were like, is there anything to do with just yields? And sure enough, when we did kind of some searches, TruYields.com was available, and it kind of just felt like a very good name for us, because it kind of hits to the point of the types of products and what we want to build and what we do. And so that was the reason for the renaming, but we also tied that in with a rebrand as well. So completely different look and feel for both our kind of website, brand appearance, and also kind of application as well. So we bundled that all into one and kind of released it in March of this year.
Nice. And there's 3 products, right? Yes. I think one was also this year, March.
Yes.
So you got TrueCore, TrueStake, TrueVault.
Yes.
Let's imagine an institution is watching this.
Sure.
Like, how do you describe the difference?
Yeah, so TrueStake was the first product which we launched in the market, which is an institutional grade liquid staking protocol. So it's a liquid staking solution for clients that have crypto native assets like Solana, Ethereum, Injective, Near, Polygon, whichever the crypto native asset is, so long as it's operating on a proof of stake blockchain. We provide a liquid staking service or institutional grade liquid staking service for that. So clients can essentially generate yield from staking, but also have that as a liquid instrument to use, hence liquid staking. So that's the TrueStake kind of product, and that's where we first launched to market in 2024. We've now gone further, I guess, away from just crypto native assets to now supporting yield products, which are US dollar based, and that's TrueCore, which is US dollar and tokenized real world asset yield products. And so this could be anything from a tokenized treasury bill to a tokenized fund like private credit. Could be a tokenized gold fund that has some type of embedded yield as well. But all those products are US dollar denominated. So for clients that have large stablecoin balances or just balances on chain that they want to preserve in almost US dollar denominated terms, we now have a suite of different kind of products that will help to service them from a yield perspective. And that's TrueCore. So you have TrueStake, TrueCore, and the last one is TrueVault. Or TrueVault. So TrueVault is essentially bespoke yield strategies that can use the other 2 sets of assets in order to generate additional rewards or additional yield, or to reduce risk. One kind of such example might be, taking your TrueCore asset and essentially borrowing against that and looping it. Or it could be a more bespoke tailored strategy to offset the price risk. So you could essentially have a TrueVault, which takes in a TrueStake asset, and that's a very volatile asset, but it's paying you yield. You could have a strategy in TrueVault, which essentially uses the yield from that TrueStake asset to put on a hedge for the price exposure. So there's a few different things, and it's a lot of different strategies you can do. And that's what tends to get kind of institutional clients also quite interested, is the type of flexibility and malleability you have with TruVault. You can do an awful lot in that Vault-like setup. And so those three products together are kind of what we call the yield engine of TruYields.
Where do most institutions start? Because that's a lot.
Yeah, I would say most start either in TrueCore, so that we can have some very, let's say, low risk type products like a tokenized treasury bill, almost as low risk as you can possibly get in terms of, it's called the risk-free rate for almost a reason. And then others will probably start towards TrueStake in terms of if they've got already crypto native exposure in an asset like Solana or Ethereum or whatever other kind of crypto native asset they have. Typically, after holding it for a period of time and getting comfortable with the asset and getting comfortable with the fact that they want to be invested over a longer term, they do typically want to earn a yield on that if they can get it. And TrueStake is as close to what you would say the risk-free rate of return is on chain or with a crypto native asset, because it's linked to staking, which in and of itself is a very, very low risk activity, even for crypto, which I know is associated with a whole host of risks. So that's where people typically start. It would be a low risk or lower yielding asset on the TrueCore side, or if they're more crypto native, have more crypto assets, it'd be an asset on the TrueStake side.
I was looking at liquid staking versus staking.
Yes.
I'm going to throw this out there and try and explain what I think liquid staking is. Please correct me if I'm wrong.
No, absolutely.
So liquid staking, in simple form, I read as they would receive a receipt token for the locked coins, but then the receipt can be traded as well. So they can earn on the receipt.
Yes.
Which to me, it doesn't make too much sense, because I'm earning yield on the on chain.
Yes.
But I'm also I have liquid capital. I have liquid coins in the receipt as well.
Yeah.
How does that work?
Yeah. So, and maybe just to frame it as well with staking, because you're absolutely right. It's a good description as well, but it can be a little bit confusing at times. So with staking, you would essentially stake or delegate your coins or your tokens to a validator, which is validating the proof of stake blockchain network. And as a reward for doing that useful activity, and helping it to come to consensus, you get a staking yield or reward paid back to you as the person who's essentially staked their assets on that particular blockchain. So that could be anywhere between 2.5%, 5%, 10%, depending on the underlying blockchain. The percentage is not too important. Unfortunately, or by design, when you delegate your assets to a validator on a proof of stake blockchain, they're almost like locked up in escrow. So it's the same as putting your money in a bank account with a high interest savings account that says you can only withdraw it once every 30 days or once every 5 days, or for this 48-hour period before you can have a cool off and take your money back, which isn't great. It's quite capitally inefficient, or at least there's a lockup or illiquidity, you could say. So what liquid staking tries to do there is it tries to provide you with the staking reward rate, but still enabling you to have liquidity. So the way in which it works is when you delegate your assets, rather than delegating them directly onto a validator, you essentially delegate them to a protocol like TruYields. We would essentially delegate them onto an underlying validator. But once those assets are on the validator, essentially locked for the same time period, depending on the unstaking window that you have, we at that point as TruYields, we mint you a receipt token, which is essentially just a receipt of your underlying position on the validator. So it's basically like an IOU. It's saying, hey, I have these assets, they're staked on the validator, and I'm going to take this kind of receipt and I'm going to go use it elsewhere. So you could essentially go to somewhere else and you could say, hey, I've got these assets over there, which would be saying, I've got these assets in a bank over here. Can I pledge those as collateral? Can I use these to generate additional yield? And that's the liquidity you can get, because that receipt you have, or those receipt tokens, more clearly, they're fully tradable, permissionless, and they're not locked. But whoever holds that receipt token can go and redeem the underlying. So if you wanted to have, it's that ability to redeem the underlying that gives those tokens value and enables them to also yield at the same time.
That's a good explanation. And to me, who has no limited experience in this field, that sounds like a great deal.
Yeah.
Is this? I know it's a disruptor, and there's a big future for this. But how does traditional finance view this? Because that is clearly an advantage that they don't have.
Yeah, I think in traditional finance, there's not too many comparables, and that's part of why, especially in certain regulatory environments, it's been quite challenging to get certainty on what that actually is, because there's very little for them to compare it against in comparison to traditional finance. I think if you get into the world of, private banking and even kind of in the other types of, let's say higher order financial services, you are able to get products which are probably quite similar. Like if you were, had 100 million in the bank would probably give you a line of credit for an awful lot of money, and it's almost the same thing. Like you're having your assets deposited over here. There's probably certain lockup conditions. You probably can't move all your assets in a very short period of time. But another bank or financial organization, knowing how wealthy you are, will probably give you, flexibility, a line of credit, whatever you're wanting, because they know you're kind of good for it, but it's more of a trust-based relationship. Here, there's no intermediary, there's no middleman there. There's nothing but the underlying code and blockchain itself, which is what makes it very compelling, because this type of financial instrument is available to anyone. It doesn't need to be somebody who has $100 million in a bank, in a private bank that supports them and provides those services. These types of benefits are available to anyone that holds crypto native assets on chain and wants to utilize these products. That's the compelling part.
Let's imagine I'm a hedge fund, me personally.
Yeah.
And I've got 20 million that I'm looking to, I guess, invest in you and use TruYields.
Yep.
Like, I want to try and understand the process a little bit more. But before I do that, what are some of because this is relatively new.
Yes.
Certainly for the the standard market. What are some of the objections these institutions have before committing to something like this? And actually, I made a note earlier that, and please correct me if I'm wrong, that
That's fine.
I think in traditional finance, I know in traditional finance that if I make a payment through the bank, I can essentially speak to the bank. If it's wrong, I can claw that back. In this world, the payment is final.
Yes.
Yeah, that's like, we're talking a lot of money here, and that's a final payment. There's going to have to be so much trust. But how do you personally and as a business manage that relationship from the very, very beginning?
Yeah, absolutely. There's a whole host of things that institutional clients are worried about and rightly cautious of. And they need to be, because the way in which blockchains operate in comparison to traditional finance can be quite different. You're absolutely right. In the traditional world, there is typically somebody to pick up the phone to, there's somebody to complain to. And especially if you're a business, you will have a relationship manager, and you'll be able to fix things that do go wrong. For example, if fraud happens on your card, there's somebody to pick up the phone and kind of claw back whatever's been stolen. In crypto and the blockchain space, once a transaction goes through, it's final, it's irreversible. And that's kind of the benefit, but also potentially the risk for certain institutions. If you sent it from one wallet and it went to another one which you didn't want it to go, let's say you got a slight error, or there was a phishing attack where they were able to put a spoof address or incorrect address and essentially send out the assets where you thought you were sending to one wallet address, but actually kind of sends it to somewhere else.
I've seen a few of these.
Yeah, and there's most of these attacks are kind of phishing related, so it's typically kind of human error in terms of downloading software you shouldn't, opening an email you shouldn't, all these types of things get around to it. But blockchain and crypto are and have the potential to be impacted more so than other types of finance. So I'd say there's a few things that we make sure that we have in place, and kind of protections we have in place for both clients and just in general, regardless of that. So the first is making sure that we are KYC and AML compliant. That's a non-typical thing for the crypto space. Typically, what you would have is a blockchain wallet, and you can connect that to whichever application you want to and start interacting in a permissionless way. And unless that wallet has interacted with some type of on or off ramp where identity was needed to be provided, it's very difficult often to understand who is behind that wallet address, especially if they use a VPN, they don't connect to any other services tied to their identity. It's very difficult to tell who's behind that. Now, we don't want that to be the case. We want to know who is interacting with our products. We want to know who's interacting with our smart contracts. So we onboard each of the clients that we service. They go through a rigorous KYC and AML process to make sure that we're comfortable with the risk of onboarding any particular entity. And as mentioned, we have that ongoing monitoring throughout. But it also means, people can't just permissionlessly connect to our applications, to our smart contracts, or use our products. You have to have gone through that onboarding process, and then we add your wallet to what we call a whitelist or an allow list. And that essentially defines which wallets are allowed to interact with your products and with your smart contracts. That's the first kind of layer of security, which gives our clients comfort that they know exactly who is interacting with what we know, everyone who's interacting with our protocol and our smart contracts. And that's kind of number one, table stakes. Most institutions won't interact and look at any services in the crypto space if they don't know who's behind it or who could be interacting and essentially involved with that particular project. The kind of next thing that we always make sure that we have in place for those types of clients is we also want to integrate where they do typically hold and custody their assets. So all of our services are what you'd call non-custodial or self-custody. So a client remains in full control and custody of their assets throughout using our products. We don't ever take them in. We don't store them. We don't hold them on behalf of a client. A client is always in control of those assets. But typically institutional clients, they don't just, they don't open up a browser extension wallet with MetaMask or Phantom and start deploying millions of dollars of capital, right? They're sophisticated actors. They typically have multiple providers. They will either use a qualified custodian. So these are custodians with certain kind of licenses and regulatory statuses, both in the US and globally. Or they will use a self-custody style of wallet, which requires multiple different signers. It's kind of MPC wallets. This is Fireblocks, Utila, 4DeFi, a few large players on that side. So we make sure we natively integrate with or have support for our assets at those types of custodians. And that's important because it means you as an institutional client, you don't need to move your assets from where you typically custody, store, or hold them. You can essentially continue to use them within the same interface, same custodian that you typically do, while still getting access to and having the benefits of our products. So those are probably the two most important, and can touch upon some others, but those are the most important things for most clients is custody and then obviously the legal, regulatory, and kind of AML risk.
It's quite clear that you and TruYields are one of the good guys in an industry that is full of, rightly or wrongly, I guess, cowboys.
Yep.
Some people will look at it like this.
Absolutely.
For want of a better word. You go through all the checks to security to compliance. So I'm not necessarily looking for a real life story, but what does a disaster look like in your world? Either hypothetical or something industry which is publicly known.
Yeah, absolutely. I mean, there's been a few recently as well, and there's a lot written in the news and people would have seen around DeFi hacks and vulnerabilities and just outright fraud as well. FTX being the most kind of pertinent example with Sam Bankman-Fried and FTX. That was really just fraud, essentially saying they had assets. They were a crypto exchange. For those that don't know, crypto exchange, a centralized crypto exchange which did custody user assets, enable them to trade on their platform. And the idea is it should always be one-to-one backed. It's not like even a bank where there's a fractional reserve component. It should be one-to-one backed with the assets that a client has deposited. They can trade on those or trade with those assets, and then they should be able to redeem one for one at any point in time. So a run on the bank shouldn't actually ever be possible with a crypto exchange because there's no need for it. The bank doesn't start or the exchange doesn't start minting money out of thin air in order to service other parts of the business. But what happened there was FTX was a crypto exchange, also had a hedge fund business on the side, looking to kind of invest in projects and make money or in markets in general. They basically took funds that were deposited by users and they fed it into the hedge fund, which was loss making or trying to make up for loss. And then they had a liquidity crunch because they had certain people asking for their money back, and they realized, they said, sorry, we don't have it. So that's like one very tangible example.
Did he go to prison?
He did go to prison for a long time as well. It was over 25 years.
I remember that story.
So that was a big one. But that wasn't necessarily anything crypto specific. That actually could have been kind of any financial organization. It just so happened that it was crypto, which is like a massive shame, but it certainly set the industry back. I'd say more pertinent are recent examples where there has been a variety of what you'd say hacks or vulnerabilities in smart contracts which have been exposed, or even very sophisticated phishing attacks on high value protocols that have held or had a large amount of assets locked or tied in smart contracts, where essentially there is almost a honeypot. It would just like, if you could get access to that particular contract or break that particular vulnerability, you can get tens, hundreds of millions of dollars. And two most pertinent at the moment, one was Kelp DAO and one was Drift, both a couple of on-chain protocols, and they're both quite different in terms of what happened. And it's not for this episode, but what a bad situation looks like is that, as we mentioned, it's irreversible. Once assets have been sent on a blockchain, they are gone. There's no way for you to kind of recall those assets. in some instances, there were hundreds of millions that was essentially hacked, and within the space of 10, 15 minutes, it's been sent from, or is held, user assets which were held or locked in a smart contract have then gone essentially to the hacker, who's then started to kind of wash those and try to remove trace of the assets, which is also not super easy, but can be done. And you've got North Korea, I think Lazarus Group are probably the largest. You've got some very sophisticated actors who have been doing this for a number of years. And if your OPSEC and security is not up to scratch, then there's very, very real risks running a business or a crypto on-chain business that you have to deal with. Whereas in the traditional world, like we were mentioning, the payment system and financial system works somewhat differently. So you can probably have comfort in certain protections being there, whereas it can be a very hostile environment to operate a business in, especially if you have a semblance of success and have quite a lot of assets under management.
So one thing you mentioned there about somebody breaking into a smart contract. If there was one thing that I thought I knew, is that smart contracts were secure, completely 100% non-breakable.
Yeah.
How does somebody do that? Is this a phishing attack where somebody would have had to done something to let them in, or have they actually hacked into the smart contract?
So it depends. Some smart contracts, what you'd call immutable. So therefore, once they're deployed on chain, they can never be changed or altered. Others are mutable, so they can be upgraded. And often what happens is there is and typically is an upgrade authority, i.e. a wallet address, which has the right to upgrade that particular smart contract. And so in some instances, what the hacker does is it enables them, or what they try to do is get control of that upgrade authority, and then basically rewrite the contract, change certain parameters that would enable them to essentially steal the funds in some way, shape, or form. In other ways, even if the contract is immutable, there may still be vulnerabilities within it. It's just that somebody may not have exploited them. So the code will be self-executing, will execute depending on whatever instructions it's given, and typically it's very rigid, closely defined structures and functions which should limit any type of attack area or surface attack area, but that's not always the case. And sometimes the contracts will operate as they should, but there should be other checks and balances to make sure that if this does happen, then a time lock, for example, if you had $250 million in a particular contract, you probably shouldn't enable all $250 million to move within one block or whatever the time may be. So there's certain kind of backup security measures that you can have in place, and a lot of protocols do, not a lot, but some. And for those that don't, they expose themselves to these types of actors because they say, okay, well, if all we need to do is break that one particular piece or get access to that one particular piece of the infrastructure, how do we go and do that? Okay, well, can we get a couple of insiders? Can we do some social engineering to get enough kind of signing authority to change some of the contracts? And if they get that, they know they've got $250 million. It's a big prize at the end of the day, so it's worth them spending a lot of effort. And you do get some examples of where, and I think this happened maybe with Drift, they had a long-running relationship with basically the group that hacked them for near enough a year, and that group put in millions of dollars into Drift, were pretending to be kind of almost a business that was trading on Drift, which was an exchange of sorts, and all of that with the view to generate trust with the Drift team. And typically that looks like a very normal working relationship, I guess, up until the point. And then once they realized what they need to get access to, they got access to it, and then obviously the exploit happened. So it's you have to be very, very careful. But yeah, it's a scary space.
1 year of building a relationship.
Yeah, I think they were in it for the long haul. It's very it's kind of scary, but also impressive at the same time.
Yeah. Going back to my question before about if I'm a hedge fund, I've got 20 million, if we've got some luck, there might be someone watching who's works at a hedge fund, has 20 million. Like, they come to you and what happens? What is the workflow of first interaction? How much do you advise? Where do they go? Is it spread across the products? To understand it.
Typically, we steer clear of advice too much because we don't want to kind of go into certain areas which are more heavily regulated. So we often work with sophisticated players that know what they do want to achieve, but they're wanting to assess, okay, what's the best route for me to generate this yield safely? Which protocol do I feel comfortable using on whichever blockchain? And what type of assets they're looking to generate yield on specifically. So it would depend on kind of what their current asset selection and composition is, whether it's crypto native or do they also have a large stablecoin balance, what level of return are they looking to get. And then based on that, we can work with them to figure out exactly what kind of composite of products may or may not make sense. And typically we start relatively small. We'll start with whatever they feel comfortable with on one of the products, make sure they understand the benefits of that, make sure from an operational and custody perspective, everything works as intended. And then once there's comfort in kind of any agreement or any kind of commercial relationship, we hope to scale that over time by proving the value that we do provide to those clients, and the utility and benefits that they do bring. And typically that's where we see over time those kind of client balances tend to grow with the trust and the value along at the same time.
Matt, I've got my biggest softball question of the day. I understand where the yield interest comes from in a bank.
Yeah.
I would bet most people watching this don't actually know where yield comes from when it's on the blockchain.
Yes.
Where does it come from?
So there's probably a few, there's probably 2 or 3 ways in which you can like sustainably generate yield, or where yield comes from. One is, as we spoke about before, one typical yield source on chain or in the crypto space is staking. So if you are operating on a proof of stake blockchain, and the way in which it comes to consensus, you essentially will stake your assets in order to provide assets to the underlying validator to participate in consensus. For that, each blockchain will have a certain level of reward or yield they pay out to people who do that, which is essentially the yield you then generate for staking. So that's one in terms of just for proof of stake blockchains, they all do staking, and so very kind of risk-free rate of return. The next is by lending. So typically most financial markets, whether it's traditional or even the crypto space, you can obviously get rewards for lending out your assets. You can say, hey, I'm willing to give you $100,000 worth of stable coins if you pay me 8% per year, or whatever the figure may be. It's just rather than going to or having a bank, which essentially pays you a certain amount for putting it into a savings account, or vice versa, because obviously you can borrow as well and you pay for the privilege of borrowing, whether it's in the traditional world or in crypto space. Lending and borrowing is a huge market within the crypto world, and was one of the first primitives to come around. So lending and borrowing is another way in which you can either generate yield if you're lending those assets, or essentially obviously paying the yield if you were with the borrower in those instances. The key difference is just there's no intermediary. It's just you almost peer-to-peer on a blockchain going from person A to person B, or entity A to entity B, and you do that via protocols like lending and borrowing markets like Aave, Morpho, and a few others that enable you to generate that type of yield. And then I suppose one sustainable source of yield, which we're now starting to see more of and comes to the products we're building at the moment, is in the traditional world, there are many mechanisms for generating yield. One might be tokenized treasuries, for example, lending to the US government, or it might be a private credit fund, again, lending to certain types of businesses in the promise of a rate of return. So you lend to a business, they build some infrastructure. Let's say they're building out an AI data center. They know it's going to kick off cash, but they need the money now to build it. You have loads of private credit funds who have gone out there and lent huge amounts of money to these businesses. And it's quite a predictable sort of cash flow. And so they're very willing to pay 8-10% plus in order for getting that capital right now, because they know over the next 10 to 20 years, they're going to be making a lot more than that, and they're willing to pay for the privilege. Now, typically, those types of private credit funds are reserved for ultra wealthy individuals, family offices, investment banking clients. But what's cool about crypto is that we've worked with and now have a way in which we can bring that private credit fund, represent the value of it, or essentially tokenize it on chain. So now you've got the representation of that private credit fund on chain, along with the cash flows as well. So you as an individual, or some of our clients, they'll be able to essentially buy or swap stable coins for this tokenized private credit fund, and it's going to be generating them 8-10% denominated in US dollars, and they'll be able to get liquidity or sell in and out of that position whenever they want. And so that's probably the third way in crypto at the moment. You're starting to see more of these yield opportunities or yield sources that exist off-chain or away from the blockchain space being brought on-chain and made available to users who obviously participate in the crypto ecosystem.
Wow. I didn't know there were so many options.
Yeah.
It's incredible.
There are others, but yeah, probably not sustainable, so I wouldn't want to touch them too much.
Yeah. Why Dubai? Why not Singapore, Switzerland, stay in London?
Yeah.
Why Dubai?
I think London's a great city, first of all. So I think it's an amazing city, amazing place to be. Lots of fantastic talent as well from a an engineering perspective. Certainly, in terms of value, I think it's right up there. In terms of elsewhere in the world, and from a financial hub, it's brilliant. But especially on the regulatory side, London, the UK in general, hasn't been super favorable or that favorable at all towards the crypto space. There was a kind of fluttering of it at some point, I think, during Rishi Sunak's short tenure. But yeah, it was short-lived. And I think that makes it very difficult to operate a business that is very heavily embedded or focused on the crypto space and needs clarity from a regulatory perspective, and also wants a regulator that is willing to engage and understand the novel technology, understand what's different, what rules that were previously in place for traditional finance can still be applied and nothing changes, which is an awful lot, to be honest. It's just a technology to deliver similar financial services at times. But then there are also things which are completely unique to the crypto space based on that technology, which weren't possible before. And it's saying, how do you see that? How do we define that? Who should it be made available to? What are the requirements and restrictions that we need to be aware of and operate on? And as a business owner and kind of running TruYields, all we want really is clarity on that side to make sure we're doing things correctly. We just want the rules off the road. And that was part of the challenge in the US for a long period of time. There was a very hostile environment to operate a crypto business. And the regulatory side was regulatory by enforcement, where you had the SEC coming in and basically fining and going after a lot of big players without saying what they were kind of taking them to the court for. It was a crazy situation. So that took a lot of the US out of the equation because it was almost a no-go area for a long period of time. And now it's turned the corner, but for a long period of time it was just don't touch, don't serve US customers, don't sell any business there by any means. And you had other areas, for example, like you mentioned, Switzerland, Singapore, that are pretty attractive. But I'd say Dubai, in terms of the ability to get things done and the willingness to move both from an institutional perspective, but also on the regulator's side, there's just a commercial lens to it, which I think generally favors setting up a crypto business here or operating a crypto business here as opposed to those other two areas. It's more fast paced. It's got a great time zone as well in terms of being between East and West. And that kind of really does help if you have clients both in Asia, US, Europe. It's honestly a fantastic time zone to work from. And for me as well, from the UK office, I get the first 3 to 4 hours a day peacefully to work on stuff. That's the most important. So that for me really was the main reason. Just geographically fantastic, well-connected, friendly regulator environment, and a willingness to engage commercially that just probably wasn't present in all those other markets.
To mirror some of those, yeah, the time zone here is great.
Yeah.
It's great, but it's also a challenge because I now find myself working more hours because I do the UK stuff in the morning, the UA stuff, I'm doing the US stuff in the evening. So it's wonderful because it bridges everything.
Yeah.
Talent here is great. I think it's very not easy, but there is access to great talent because a lot of great people move here.
I think more and more people, we're seeing people move out, which is something which is super encouraging. Obviously, recent conflict and everything else has probably set things back slightly. I don't know what you're seeing on that side. I know a lot of people who were looking to move out, if they made the move, a lot of people realize they're here to stay and they didn't think too much changed on the ground and they're very happy to stay. I've seen very little people who came and want to move back, but I think those that hadn't had the chance to make the move beforehand are probably slightly more hesitant, or it'll take them another 6 to 12 months potentially to see how things play out. But you're absolutely right. The density of talent in terms of people moving across is, it's very impressive.
And it's a certain type of person moving over here. It's people who want to achieve, people who want more from life, which is wonderful for business owners to access that talent. And I think I agree actually that people are now delaying their move over here. I think if you look online and news outlets and media, it looks a very bad place.
Paints a very different picture from what's on the ground.
On the ground is very different, yeah. Cool. You also made some notes on the sheet, part the crypto stuff for a minute. Sub 3 hour marathon.
I was asked about that, so just to do that. In terms of from a personal perspective, it's something which I got into actually off the back of COVID because everything was closed from a gym perspective. Couldn't play sport in the same way in which I could before. Just started running, did a kind of 5K. Didn't really take running very seriously for a while, and then just thought it'd be a good idea to enter a marathon. And that was, I think, back in probably 2023 at some point, and then just grew to love it. And it's one of those things where I think it teaches you a lot of useful life lessons, both in the training, but also racing, but just running in general, like you have to keep going. Otherwise you literally stand still. It's not even like when you're on a bike and you could take it easy for a second or two. You're still kind of moving in the rough direction you want to go. Running, you literally step by step have to continue going, or things stand still. I find it translates in a lot of ways. And there's a lot of very unglamorous parts of training for either a marathon or any type of race, which kind of go unseen, which are, yeah, you're super sore, tired. It's raining outside, probably not in Dubai, but in the UK it might be. And you don't want to go and do that session, but you've got it planned and you really want to hit the particular target. And I think it teaches you, especially for me anyway, when I really started to dial in and focus on, okay, what do I want to achieve? Okay, I wanted to run a sub-3 after a certain number of years because I felt like it was attainable. Okay, what do I need to do that? And so you ask people around you, like, who've been successful, done it before. What does it take? What should I do? And you get all the advice and kind of formulate some type of plan. I was lucky. I spoke to a few people who, done it a number of times and were great in terms of guidance. But there's a set plan. You've got to hit certain paces and you've got to do certain sessions. And it's pretty grueling. It's pretty unglamorous. It's not that fun at times, although some of it can be. But that if you do hit all those things and you hit that process and you continue to day after day tick off those kind of process-based goals and you just do it, then the marathon at the end is kind of just the reward for that. It just shows where you are, and it basically humbles you. You either hit your goal because you've trained well enough for it and things have gone well on the day.
A bit of luck on the day always helps.
A bit of luck on the day, because and you wouldn't otherwise be able to achieve it. No one really rocks out of bed and runs like a sub-3 marathon, or even far. There's somebody run a sub-2 hour marathon, right? So sub-3 is not even impressive. But I think the process of working towards a big overarching goal, having things each day that you try to tick off towards that. And I think it translates a lot into the business world as well, because there's always things you can do from a process perspective. And then the end outcome kind of just takes care of itself. It's not that you need to worry about the end time or the end goal, whatever it might be from a business perspective. You just know that if you continue to do these things day after day, the probability you're going to have success rises. Not that it's an absolute certainty, but you give yourself the opportunity to be successful in whatever you're going to do. So that for me, is definitely why I'm still at it and really enjoy it.
That's good. I think the mental resilience in running, because it's pretty tough. An hour and a half in, you got to keep going. You got to keep going, but when he finishes, it's actually a good feeling.
Absolutely.
What about raising investment? Like, I've spoken to many people who have raised investment.
Yeah.
Don't believe I've spoken to anyone who's raised investment for a crypto native firm.
Yes.
Obviously, raising investment as a SaaS startup or an AI startup, you look at recurring revenue, you look at the existing team, you look at total addressable market. Do the same metrics apply when raising for a crypto firm?
Yeah, I think the same metrics do still very much apply. For a while, maybe they didn't, because crypto was this kind of unknown entity and people weren't sure on how to value it, essentially. And so people would say, it's got a token, it's got a great team, it's got great marketing, it seems to get a lot of attention. Well, we should invest in it. And it works to a certain extent, but over a long period of time, and you'll see this at the moment, there's a huge divergence between businesses that generate revenue in the crypto space and those that don't. And even at the moment, as we speak, there's been massive reallocation towards those that are just very good businesses, that are just cash cows, generate huge revenues, very, very lean in terms of the number of people they employ. I think some of the most capital efficient businesses that are generating billions of dollars are in the crypto space, because you just need orders of magnitude, sometimes less people there. For raising money though, it's a difficult situation, I think, for any founder to often approach. You have to think about which investors are going to be important for you, which ones strategically important, in the sense that if you are at position A and you want to get to position B, what type of things need to go your way? How can you bring investors along that will help you to achieve those outcomes? Or do you just want the capital because you think you've got everything sorted on that side? So I think it's important to know which investors you want to go to. We closed our initial round in 2023 with a great subset of more crypto native investors, as well as Brevan Howard Digital, which was obviously more of a traditional name, but very much on the crypto native side. And then when it came to raise money in 2025, we, based on the products we wanted to launch, knew that we wanted a larger, more traditional name on the cap table. And so we were very fortunate to have great partners in Standard Chartered who saw the vision of what we were trying to build. They were probably less further along on the risk curve, especially than some of the more crypto native investors that would invest at an earlier stage. But then when you get to Series A, you have to have demonstrated product market fit, initial traction, go to market success. And for us, we'd gone from, I think it was $10 million worth of assets under management, or TVL as we call it, to over $300 million. And so we'd shown a good level of growth with a certain level of customers or certain first set of customers. And then that's enough. Well, if you have that level of growth, it should be enough to obviously raise the next round of funding to say, if we get this amount of money, here's what we're going to do. Here's what our plan is for that. But, the market was also incredibly difficult in 2025. And it took us a lot longer to close than we would have liked. So I wouldn't say, we had it nailed, we had it sorted, it was easy. It took a couple of months. It was an absolute slog. It was really difficult, and it detracts away your attention from the rest of the business. But I think just understanding who is likely to invest in you and why is a really important consideration, because otherwise you could spend a huge amount of time wasted in terms of contacting people who maybe would have no interest in the type of business you're running.
Mm. I made a note about that earlier. You referenced $300 million TVL, total annual locked.
Yes.
To me, that seemed a big number. That's a very big number. Is that strong for your industry? And then what's the next milestone?
Yeah, I think depending on the type of stage you're at, it's a very important metric. Anything beyond 100 million plus in TBL shows you've demonstrated significant product market fit, even if it's for a particular niche product and set of customers. Getting clients to part with over $100 million worth of assets and trust you or entrust you with that through your products, although they keep custody of the assets, they're still utilizing your business for that and accessing your yield products, which they then choose to hold. So there's a certain amount of trust which you have to engender, and obviously the sales cycle for institutional clients can be quite long. So I think anything 100 million plus is fantastic, and typically is enough to then get you a certain level of funding to kind of hit the next level. And in terms of next level, it sounds crude, but $1 billion plus is exactly where we want to be and where most of the industry strives to get to. At the moment, there's probably only, I'd say, between 10 to 15 businesses in the crypto space, at least on the DeFi side or protocol side, that do have that much assets under management. But there's others that are custodians, exchanges, and other types of crypto native businesses which have billions upon billions of dollars in crypto assets, like hundreds of billions in certain, at least around $100 billion. If you look at Binance, Coinbase, and some other big names, they're just phenomenal crypto businesses, and others that hyperliquid have come up recently, and that's really where everyone strives to be.
Have you forecasted when you're going to make that billion TVL?
We would love to be able to get there by 2028, but obviously there's a lot that needs to go our way till then. But we're actively striving to make sure it happens.
This question has just popped into my head now. Is this the type of business that you do outreach for? Do you go out and actively try and chase clients?
Yeah.
Or are you fortunate that referrals might play a big part and I guess inbound based on relationships?
Yeah, I'd definitely say it's a bit of both. So as with any business, I think outreach is super important, just in order to kind of get your name, your brand out there for people to recognize, even if a huge amount, initially doesn't necessarily convert. But you also want to make sure you do have a strong level of referrals coming through from existing client base, your investor network. As I mentioned, strategic investors are important because, okay, who do they know? What other funds do they have that invest in liquid assets that they could be looking to utilize your products for? So we had a lot from a referral basis initially when we started out, and some of our existing clients obviously then speaking to new potential clients, which was very helpful for us in the first instance. And we really looked to leverage the network that we did have from investors, whether that was Brevan Digital, Lays Digital, or others. And so we really lent into that because it was a core strength, and that's where we could generate a lot of trust from the relationship and backing we did have, and we made sure to use that. But as the business grows, that kind of can sometimes be capped, and it's therefore really important to, in the same way most SaaS-based businesses will generate revenue, you need to have a pipeline. You need to be kind of very aggressive in terms of going out and outreach, but also very focused as to who you're looking to target and knowing what particular pain points and problems you're solving for. And so we have a few different ideal customer profiles that we really look to target and service, because we think we know their problems and their businesses very well, and we feel that the products we've built can be very helpful and serve a lot of value for them. And so in a similar way to most SaaS-based or enterprise SaaS organizations, we do have a lot of outreach, and that process can be quite long in terms of converting as well, because there's a lot of hoops you need to jump through, both from a risk, compliance, and security perspective to get them over the line.
Have you won any business on the paddle court yet?
Oh, paddle court, it's getting there. I made a few good relationships recently, so I'm hoping they will turn out, especially since moving to Dubai. It feels like it's almost like the new golf course, right? There's so many people who play paddle out here. Everyone's there, super engaging, and typically come from all different walks of life as well. A lot of different industries, but there's almost that melting pot of people who, my friend does this. And so there's a good amount of crossover that you can definitely generate on the panel call for sure.
Good. There was something quite impressive that I looked at earlier, and you have a sub-advisor, a Wellington Management, who are tier one trade finance name, a huge company. How do you get them to engage with the crypto business?
Yeah, so I think a lot of that comes through our investment by Standard Chartered. So Standard Chartered being kind of the brand that it is and known around the world. They have a series of both portfolio companies and other relationships. And for us, we want to provide yield products. And this one, for example, is tokenized treasury fund. It's sub-managed by Wellington Management. So they're the ones who are actually dealing with the management of that fund and that capital. And that's where investors have security because they know this capital is being looked after by your organization that's been around for nearly 100 years, whatever it might be. And so really for us, it's through that network of our investors that we're able to tap into and credibly work with some of these organizations in the same way in which we historically worked with Laser Digital to launch regulated funds on the liquid staking side. It often becomes around, okay, who is your investor base? And therefore, there's trust that you're building things in the right way, and it opens the door and unlocks the ability to work with those types of providers. And having a very clear institutional focus, even though we're operating in the crypto space, enables us to kind of credibly say, hey, these types of products are going to work well with our types of clients because we service the same type of buyer, but just in a slightly different format.
Great company to have on board as a sub-advisor.
Absolutely.
Culture. How do you manage a remote culture? Something I've done with one of my businesses.
Yeah.
Something that I often find with some clients is quite challenging. How do you make it as good as you can? I'm sure it's not perfect. Nothing ever is. But what do you do?
Yeah, absolutely. It's a good question. And before I moved out to Dubai, vast majority of our staff were London based. We're in the office for kind of 3, maybe 4 days a week at times. And so the culture kind of takes care of itself because it's almost what you're doing when you're in the office and people see and look and perceive, and it's the standards you kind of keep for the businesses or the business itself and how you run that organization. And it's much easier when everyone has visibility, literally tangible visibility, and can see and hear everything. I think moving towards more of a remote first stance, which is what we're doing now, just given the fact that more of our staff are geographically dispersed. I'm obviously in Dubai. London office is still there, but fewer people than there were before, obviously. I think it becomes very important from an async communication standpoint to make sure you're very clearly and often communicating with everyone that you typically would have otherwise spoken to in the office. Reaching out just sometimes ad hoc as well, away from just having standard meetings, to make sure that everyone is clear on what needs to be done, checking in on people, and making sure that everyone is well looked after and taken care of in the business. And then secondly, we also try to make sure that when we do have the opportunity, and I'll probably go back at least once a quarter, we're doing things socially as a team, we're hanging out, we're spending time in the office when everyone is there, to make sure that we do have that connectivity, even if it's on a less frequent basis. And I think combination of those things help people to feel more connected, more heard, and we don't want people to feel isolated and just working from a remote patch. We want them to feel part of a kind of a bigger whole as such.
I think that's very important, the in-person stuff, even if it's quarterly. People look forward to it.
Sure. Yeah.
What I found, for me personally, I don't necessarily love that stuff when I was employed anyway, years ago.
Feels a bit forced times.
Yeah, but I know a lot of people who are employed by business, they love that stuff.
Yeah.
And it's so important. I found that it's so helpful to build in a good culture if it's remote first.
Yeah, absolutely. For sure.
Let's ask one or two questions about the future, because there's no doubt the amount I've learned from you today, the other people that I've had on the podcast, that this is real, this is the future, and this is happening, but it's happening now, behind closed doors for most people. Well, when do you? This is a prediction. I'm putting you on the spot here. When do you see this becoming? I use the term mainstream loosely, but when is this normal to everyone in the street?
Yeah, I think a lot of it, especially from a technology perspective, it will become more and more normal, but it will be hidden underneath the hood. So I'd see blockchain technology and crypto as just an enabling technology in general to do things that we've probably historically done, or maybe not been able to do, but just in a more efficient manner. But really, you as an end user, you just want to get from A to B. You want to achieve a particular task. Like, let's say you want to own a particular stock. Okay, cool. Well, most people will probably use something like Robinhood today, especially of our generation. They're going to go and they want to click a few buttons on their app, and they want to send US dollars or whatever currency they have and they want, the stock to land in their brokerage account. They don't know anything about what happens underneath the hood. It's a very complex process, but that in the traditional world will take probably a number of days to clear in terms of the payment, the underlying registry of the shares, and everything that goes with it. But there is a world in which all of that actually happens on chain, on a blockchain, and it's instant and it's settled within seconds, if not kind of instantly. And the end user just sees, okay, I've sent money and I've received that stock. It probably is going to happen much quicker than people think. Like Robinhood are already building out their own blockchain. There's a number of others that are doing tokenized stocks, and that's just kind of one tangible example where people are doing something in terms of buying equities, buying stocks, and getting exposure to a particular asset class, but now just doing it in a much more efficient way. But crypto's under the hood. You just have no idea that it's actually there. And so I think it will become more mainstream, but people maybe won't actually see the crypto element because it's just the enabling technology under the hood as opposed to something that needs to be posted front and center. Like you shouldn't care which blockchain something's built on. Like no one cares. Like you don't care which messaging system or like phone network that you use when you go on holiday. You just want to make sure that your message goes from point A to point B. So I think it'll be the same thing, but I just don't necessarily think people will see it visibly.
Interesting. Last one. I can't not ask about AI.
Yeah.
Blockchain, Web3, crypto has had a steady increase,
Yeah.
would you say, for 10 years?
Yeah.
AI has had a rocket ship increase.
Yeah.
How does this affect you as a business and your industry?
Yeah.
Does it accelerate what's happening? Does it put a halt on it? How?
I think it's an accelerant. I see both of them going hand in hand. I see both AI and crypto as two emerging technologies. And they're both, crypto had incredible run up, very volatile. People are probably overextending their expectations, prices running up to a crazy amount, which typically does happen with any new technology because people get very excited about what could it do, what could it be. It's that story, that narrative that people buy into, and it always goes beyond what it can deliver on the day. And you've seen some retracement of that initial move for sure over the last few years. See AI in a similar way, but it is also able to deliver huge amounts of value to a lot of people around the world instantly. I mean, the number of businesses or individuals at least who are using LLMs, whether it's even just basically kind of using it as a Google, which I know it's not the best way to use them, but like now you've got businesses which are completely reworking with agentic workflows, automating a huge amount of back-end processes, even our business as well. Just in terms of the code velocity and ability for our team to work on new features, new products in a fraction of the time and the cost that it would have done before, that ability to spin up those or features, products, whatever else it might be, get feedback and then work on those, it's just accelerated our kind of time to market for building new products more than anything. And then making sure, I think from a team perspective, rather than significantly changing, I guess, the existing team size, I think it just means you can do an awful lot with fewer people. Like everyone, it's like a leverage more than anything else. It's a lever for people to use, whether they're sales and commercial focused or whether they are in the operational side of the business or if they're an engineer. Anyone can be using and embedding AI in the work they do to make themselves far more productive and make the output of what they typically do 10x from where it was before. And I think that's the biggest impact that we've seen in the business. And it's just trying to encourage and bring everyone up in terms of the quality and the use of AI within the business, because it's real. Like it's 100% real. You've got engineers at Anthropic saying they haven't coded for like over a year and they're developers of some of the most forefront technologies. And kind of have to pay attention to that and think, okay, well, the way in which we used to do things probably isn't right. How do we adjust and change that based on this new technology, and how can we improve? Because if you don't, competitors are, right? So I think that becomes the threat to people who kind of stay stuck in the ways and don't start to integrate it deeply.
So true, but it's quite overwhelming as well.
Massively.
For most people.
It feels like a treadmill.
It's like a new tool every day. Yeah. Matt, I've really enjoyed this conversation. I have learned loads today. I have no doubt people watching would have learned loads today. And I hope you enjoyed your first in-person podcast.
Yeah, it was awesome. Thank you so much for having me.
Cool.
Thanks, Matt.
Thanks, man. And that's it. That's the end of the podcast with Matt. I hope that you learned as much as I did about blockchain and the Web3 space. Please don't forget to like, comment, and subscribe. And I'll see you next week for next week's episode.